This is Dr. Thiruvengala Chary, Assistant Professor of Commerce, Kakatiya Government Degree College, Hanmakonda. As part of the Common Core syllabus of Government of Andhra Pradesh, BCom second year, first semester, Advanced Accountancy subject, one of the most important topics of Advanced Accountancy is Valuation of Goodwill. Today we are going to discuss the important methods of valuation of goodwill, need for valuation of goodwill, why the goodwill is treated as one of the most important elements in the business enterprise. Goodwill is treated as an intangible and fictitious assets. Different authors have defined goodwill in different ways. Goodwill is the current value of expected future income in excess of a normal return or investment in net tangible assets. This has been defined by Kohler. Another important definition of goodwill is an intangible asset compounded from a variety of successful business ingredients: competent and energetic management, customer acceptance, a favorable location, a quality and profitable product, efficient production methods, an outstanding reputation, plus the expectation that these ingredients will continue produce an above normal rate of return for an indefinite period of time. With this we can understand that an organization which enjoys the highest reputation will enjoy highest goodwill. An organization which enjoys highest and above normal profits or profits above the expected level will earn goodwill. That is why here the question of why to calculate goodwill, what is the need for valuation of goodwill. Here, before going to the calculation part, here we will see one of the few important characteristics of goodwill. It is an intangible asset and not a fictitious asset. Goodwill cannot be seen with our naked eye, that is why it is treated as an intangible asset. Another one is it cannot have an existence separate from that of the enterprise, therefore it cannot be realized separately. Another important characteristic is its value depends on the subjective judgment of the valuer. A goodwill, organizations may be having goodwill, but the value of the goodwill varies from organization to organizations. Another important is it helps to earn higher profits. Organizations having goodwill certainly will fetch higher profits. It is an attractive force which brings in customers to old place of business. Organizations having goodwill certainly will have this characteristics. This means old customers, companies or organizations or business entities having goodwill certainly will bring back to their old customers. Next, it comes into existence due to various factors such as locational advantage, favorable contracts and market reputation. Then we will discuss about need for valuation of goodwill. The need for valuation of goodwill generally varies from organization to organization. In the case of sole trader, if the sole trader firm is ready to sell to somebody else, in that case goodwill is to be calculated. In the case of partnership firms, when a new partner is entered into the existing partnership firm, the goodwill is to be calculated. In the case of a partner dies or retires from the existing firms, goodwill is also to be calculated. When there is a change in the profit sharing ratio among the partners in the existing firm, goodwill is to be calculated. When the firm sells the business to a company or when it is amalgamated with other companies, goodwill is to be calculated. This is in the case of partnership firm. Whereas in the case of joint stock company, when two or more companies amalgamated together, in such cases goodwill is to be calculated. Next, When one company takes over another company also, goodwill is to be calculated. When a company wants to acquire controlling interest of other company, goodwill is to be calculated. The last one is when the government takes over the business, also goodwill is calculated. Next, we have to discuss various factors that influence the value of the goodwill. Why the firms will change the goodwill quantities from firm to firm. There are certain factors which determine the value of the goodwill. Number one is earning capacity of the firm. The firms which enjoys highest earnings position will have highest goodwill. The firm's profitability position as well as the future earnings capacity also most important aspect in valuation of the goodwill. Next one is location of the business. If the business is located in a most prominent place, then the value of the firm which enjoys highest reputation, in turns which enjoys highest goodwill. Third one is trends of the profit. The last few years of profits, if you look at the past few years of profits, if the company enjoys highest amount of profits in the last few years, the goodwill is also maybe more sometimes. If the company has a negative cash flows, has negative returns or negative profits, certainly goodwill will be low. Most important aspect is efficiency of the management, also most important. If the organization management are most efficient, certainly the sales will be more, the revenue will be more, in turn the goodwill also will be more. Next one, quality. The quality of the products, quality of the services, quality of the customer service or quality of the business enterprise, etc. also will play most important role in determining the value of the goodwill. Next, other factors includes the government factors and the competitive level, the level of and the amount of patents that the company has also will influence the value of the goodwill. Then we need to classify various categories of goodwill. The classification, if you look into the classification of goodwill, we can classify the goodwill into two broad categories. One is purchased goodwill, another one is self-generated goodwill. Purchased goodwill means the goodwill that is been acquired by making a payment to third party. Means certainly we are buying a firm which has a more value in the market. For example, a firm has 10 lakhs worth of rupees net assets and the liabilities are only 8 lakhs rupees. The net revenue difference is only 2 lakhs rupees, but the firm may be sold for 20 lakhs to 30 lakhs rupees. The firm enjoys this highest reputation, that is why it pays more amount than the original market value of the firm. That is also one of the reasons why companies will enjoy most reputation. We can call it as a purchased goodwill, and the firms will pay more amount to buy the reputation or that organization or that entity. We can call it as a purchased goodwill. If you see the features of the purchased goodwill, the goodwill arises on the purchase of a business or for a purchase of a brand. Sometimes even to take over the brand of another company or to establish a brand also, the goodwill is to be purchased. Since the consideration is paid for it, it is recorded in the books of accounts. Particularly in the case of purchased goodwill, it is recorded in the books of accounts, and as it is recorded in the books of account, it is shown in the balance sheet of and assets. Then value of the goodwill is subject to judgment, but it is ascertained as both purchaser as well as seller agrees to valuation. The second category of goodwill is self-generated goodwill. Self-generated goodwill is internally generated goodwill which arises from the number of attributes that a running possesses. Number one, valuation depends upon subject to judgment of the valuer. Objectivity will not be there in the case of self-generated goodwill. Then the inherent goodwill, this self-generated goodwill also known as inherent goodwill. It only an estimation by the buyer or seller. It should not be brought into the books of accounts. That is why there is no accounting entries required in the case of self-generated goodwill. Then most important aspect of the goodwill element is the methods of valuation of goodwill. As far as these are the three important methods that are in vogue or much in practice for valuation of goodwill. Number one is average profits method, second one is super profits method, third one is capitalization method. Average profits method, it is very simple and easy to understand and easy to also calculate. Under the average profits method, annual business profits earned by the business for the specific number of years are considered. The last accumulated profits, suppose for example last 5 years or 6 years of profits are taken into account, these 5 years or 6 years of profit are to be added, then should be divided by the number of years, then we will get average profits. So this is the formula for calculation of average profits. Average profit is equal to total of adjusted profits. Here adjusted profits means the actual profits are to be adjusted with different elements like losses or other incomes or other elements are to be adjusted with the past profits. It should be divided by number of years. How many number of years profit we are taking, with the same number of years we have to divide. Then the goodwill is can be calculated by multiplying the average profit with the number of years of purchase, because a single year profit cannot be considered as a goodwill. Suppose the buyer or the seller may demand a more amount of goodwill to the buyer. That is why average profits, a single year or 2 years profit may not be taken into account. The number of years of purchase of average profits also most important. That is why goodwill can be arrived by multiplying the number of years of purchase with actual average profits. Suppose if you look into the example, we can easily understand the average profit method with this simple problem. Look at the problem. X purchased Y business with effect from 1st January 2016. It was agreed that the firm's goodwill is to be valued at 2 years purchase of normal average profits of the last 3 years. Last 3 years profit for the same business have seen like in 2000 at 80,000 profit, then adjustment sale of land of building of rupees 10,000 is also included in 8,000. In 2014 it was 1 lakh rupees profit, which includes abnormal loss of rupees 20,000 rupees. In 2015 it has 80,000 rupees profit. So based on these 3 years of profits with 2 adjustments, then we can calculate the value of the goodwill. So if you see the solution on the first method, the adjusted profits are to be calculated first. In 2013 actual profit is only 18,000, then the 10,000 is to be subtracted. So actual adjusted profit is 70,000. Then in 2014 adjusted profit is 1 lakh plus 20,000, it comes to 1 lakh 20,000 rupees, whereas in 2015 it is 80,000 rupees. So total profits for the last 3 years were 2 lakhs 7. So average profits 2 lakhs 7 by 3 comes to 90,000 rupees. So here in the problem itself it is given that 3 years average profits of the last 2 years purchase of average profits is given. So goodwill is equal to average profit is 2 lakhs 70,000, 2 lakhs 70 by 3, 90,000 into number of years of purchase 2, it comes to 1 lakh 80,000 rupees. So this is very simple and easy to calculate, which does not require much complications. Similarly, this simple average has certain negative shades as well as certain drawbacks. To overcome these drawbacks, another element has come into practice. That one is weighted average profit method. This weighted average means assignment of weights to the profits of the respective previous years for which we are considering. So assignments of weights can be taken as either in ascending order or descending order. Either highest values may be given highest weights, or the lowest values may be assigned the lowest weights. The formula for calculation of average profits under weighted average is total products of the profits by total weights. That means every year profit is to be taken, each profit we have to assign the weights, then the weights must be multiplied with the profits, we will get total products of the profit divided total weights. So once we have got weighted average profit, we can calculate goodwill by multiplying the number of years of purchase with weighted average profit. The same also can be seen with the help of a small illustration. The profits of the firm for the last 3 years ending 31st March for 5 years were in 2012 40,000 rupees, 2013 48,000 rupees, 2014 60,000 rupees, 2015 70,000 rupees, 2016 80,000 rupees. So these are the 5 years profits which are given to us. So based on this, we need to calculate value of the goodwill on the basis of 3 years purchase of the average profits. So if you see the table, it's very simple. 40,000 in the first year, 48,000 in the second year, 60,000 in third year, 70 fourth, 80 fifth year. So we have been assigning the weights as the least value 40,000 is given the first weight or first rank. The next highest value 48,000 is given the second weightage or second rank. The next highest 60,000 is given in the third weight or third rank. The next highest one is 70,000, for which we have given or assigned fourth weight, and finally 80 is the highest, for which we have assigned the highest weight, that is 5. So this is the way how the weights are to be assigned. Now once the weights are assigned, we have to multiply the profits with their corresponding weights. 40,000 into 1, 40. So the last column B into C means profits multiplied by respective weights. Then second one is 96,000, third one is 1,80,000, fourth one is 2,80,000, next 4 lakhs. Now we have to find the total of all the weighted profits. We call it as a weighted profits. Product of weights with profits called weighted profits. So total is 9,96,000. Then sum of the weights, if you take into account 1 plus 2 plus 3 plus 4 plus 5 is coming to 15. So weighted average equal to 9,96,000 divided by 15. So it is coming to 66,400. Now the goodwill is calculated on the basis of 3 years purchase of weighted average. Years 3 years purchase, because it is 3 years purchase, the weighted profit should be multiplied by 3 to generate goodwill. So 66,000 into 3, it comes to 1,200,000, 1,99,200. So this is very simple comparison between simple average and weighted average. In simple average, just only the number of years of profits divided by number. This is simple average method. Weighted average means for the profits, because varying from year to year, we have been assigning the weights to the individual profits. Then to have subjectivity, to have some more relevancy in the element of the calculation part, sometimes weighted average is considered the most appropriate method. That is why we have also seen the weighted average method. The another important method is super profits method. So this is super profits method, one of the prominent methods of valuation of goodwill. In this case, capital employed in a business yields some profit. Some of the enterprises will earn more profits, while others earn less profits on the capital employed. When a similar type of business earns profits as a certain percentage of the capital employed, it is called normal profits. Some firms can have some excess of normal profits. The excess of actual profits over the normal profit is called super profits. In the case of super profits, any organization generally earns some given percentage of profits. Every organization, some textile mills may earn some 40,000 rupees. Pharmaceutical companies may earn between 55 to 60% of profits. Like every business have their own destination of percentage of profits. Similarly, if an organization earns over and above the expected level of profit, it is called super profit. Beyond the normal profit, if any organization earns over and above the normal profit, or which is being expected by the organization, then we can call it as a super profit. So super profit is very simple concept. More than expected profit is a super profit. If the company earns 2 lakhs profit, if it actually earns 2,80,000 rupees, the difference is called a super profit. More than anticipated level of profit if the company earns, we can call it as a super profit method. Under super profit method, the goodwill can be calculated by using these 3 simple steps. First one is calculation of capital employed. Always capital employed is considered one of the most important element in goodwill calculation part, because the rate of return that is earned by the business is always must be calculated based on capital employed. Second step is calculation of average capital employed. Third one is calculation of future maintainable profits. Next one, calculating the goodwill. So, we will see how these three steps are to be calculated individually. First one is calculation of capital employed. Capital employed is nothing but amount invested in the business is called capital employed, or amount employed by the owner is called capital employed. Capital employed can be calculated in two ways. One is asset side approach, another is liability side approach. Here asset side approach means it is very simple. With the total assets is divided by external liabilities, we will get capital employed. Total assets at their book value should be taken into account. Total assets lo nunchi we have to deduct fictitious assets as well as non-trading assets like investments also should be deducted. From external liabilities includes debentures, other external term loans or bank loans should be deducted. So, from total assets if you deduct external liabilities we will get capital employed. This is asset side approach. The next one is liability side approach. The calculation of capital employed based from liability side is also very simple. We have to add equity share capital, preference share capital, reserves and surpluses, and profit and loss credit balance, any increase in the value of the assets by valuation, revaluation of assets. If any value of the asset increases, that is also to be taken into account. The sum of these minus any fictitious assets and non-trading assets like preliminary expenses, any write-off of assets should be deducted. We will get capital employed. This is liability side approach. While calculating the capital employed, either you can follow asset side approach or liability side approach. Then the second step is calculation of average capital employed. Average capital employed is very simple, means opening capital plus closing capital divided by 2 will get average capital employed. If opening capital employed is not given, the average capital employed can be calculated with simple formula. The capital employed minus half of the adjusted profits of the year, then we will get average capital employed. So, next third important step which is also considered as the key in valuation of the goodwill is future maintainable profits. The future maintainable profits can be calculated just with this table. First you take average past few years profits, then we have to adjust certain items like by way of adding expenses incurred in the past but not likely to be incurred in the future should be added. Then capital losses which are incurred in the past also should be added. From this we have to deduct expenses to be incurred in future but not incurred in the past. Then also to be deducted capital gains earned in the past, capital gains which are earned in the past also should be deducted. Again income from non-trading assets like interest on dividends etc. also should be deducted. Then we will get future maintainable profits. Then once we have calculated these three steps, one is capital employed or average capital employed, either of these we have to take. Then second one is future maintainable profits. Then in the problem itself it may be given that a particular normal rate of return may be earned by a particular business, as we have discussed in the previous analysis. So, every business earns certain amount of returns. So, the rate of return earned by the firms is given in the problem itself without any confusion. So, normal rate of return is also most important. So, normal rate of return can be calculated with as a percentage of capital employed. So, here we see how the calculation of goodwill under super profit method is in simple steps. We can see capital employed we have to take as a base, then normal rate of return will be given as a percentage in the problem, then normal profits we can calculate normal profits as a percentage of capital employed, means a capital employed into normal rate of return we will get normal profits. Then future maintainable profits either we have to calculate as we have discussed in the previous analysis, or sometimes directly it may be given in the problem itself. Then finally the super profits can be arrived by subtracting normal profits from future maintainable profits. Means future maintainable profits minus normal profits gives you super profits. It's very simple. Future maintainable profits may be given in the problem. Normal profits we have to calculate with the help of normal rate of return and capital employed by deducting normal returns from the future maintainable profits. Will get super profits. Once the super profits are arrived, we have to multiply number of years of purchase of years with super profits. So super profits into number of years purchase, we will get goodwill. So it's very simple. If you concentrate on these few steps, it is very easy to calculate. Now we will see one illustration how the goodwill can be calculated under super profits method. Example, from the following particulars, calculate the value of goodwill taking 5 years purchase of super profits. So 2005-6 it is 2 lakhs rupees, 2006-7 2 lakhs 40,000, 2007-8 it is 2 lakhs 20,000. So normal rate of return given as 10%. Capital employed 12 lakhs. So the profits included in non-recurring profits 3,000 rupees. So this is to be adjusted while calculating average profit. So this is the problem. Now we will see the solution. First we have to calculate adjusted profits based on the average profit. First year profit 2 lakhs plus second year profit 240, third year profit 220. So sum of these 3 is 2 lakhs divided by 3. So 2 lakhs 20,000 minus non-recurring income that is given in the problem, it is to be adjusted. So minus 3,000 we will get 2 lakhs 17,000. This is called adjusted profit. If there is an adjustment, simply we will get average profit. Then second step is capital employed. Capital employed is also given in the same problem, it is 12 lakhs. So we need to calculate normal profits. Normal profit is equal to average capital employed into normal rate of return. So capital employed 12 lakhs, normal rate of return is 10% of 12 lakhs. So normal profits are 1,20,000 rupees. So here super profits are average profits minus normal profits, or adjusted average profits minus normal profits, 2,17,000 minus 1,20,000. So super profits are 97,000. So now goodwill is to be calculated multiplying the number of years of purchase with super profits, 97,000 into 5, because the number of years of purchase is given in the problem is 5, it should be super profits should be multiplied with 5. So 97,000 into 5 comes to 4,85,000. This is very simple. Next we will see another example with the balance sheet model, because we have also calculated the capital. We can also calculate the capital employed by following either asset side approach or liability side approach. So far we have seen. So with the help of the balance sheet, how we can calculate super profits also, just we will see. So the balance sheet, just have a glance over it. Share capital, reserves and surpluses, general reserve, profit and loss account balance, credit odds and bank overdraft. Then land and building, plant and machinery, furniture, investment. So interest on investment, that is 4%, is also given, it has to be adjusted. Stock, debtors, cash at bank, preliminary expenses, fictitious assets, one of the examples. So another additional information that is given, net profits after tax 2,70,000 first year for 2014, in 2015 it is 2,20,000, in 3,20,000 2016. So return on capital employed is given as 15%. Calculate value of goodwill on the basis of 3 years purchase of super profits. Here goodwill is to be calculated on the basis of 3 years purchase. We need to remember how many years of purchase is also most important to calculate the goodwill. We will see the solution. First, calculation of capital employed. So now we are following the asset side approach. We are adding all the assets like land and building, plant and machinery, furniture, stock, debtors, cash. All this aggregatively comes to 16 lakhs rupees. From this, deducting external liabilities, that is creditors 1,20,000 rupees, bank overdraft 80,000 rupees. Total 2 lakhs should be deducted from 16. Now coming to 14 lakhs, this is capital employed. Now capital employed 14 lakhs. Now we need to calculate future maintainable profits. average profit is equal to total profits by number of years we have taken. So 3 years profit is given, sum of these 3 years profit is coming to 8,10,000 divided by 3 coming to 2,70,000. This is average profit. So adjusted profit means we have to adjust that interest on investment that is given in balance sheet, 4% of 3 lakhs, it is 12,000 rupees. So if you deduct income from investments from 2,70,000, that is average profit, we get 2,58,000. This is called average adjusted profits. The third step is calculation of goodwill. Capital employed already calculated, we have got 14 lakhs rupees capital employed. Normal rate of return already given as a 15%. So normal profits 15% of 14 lakhs. Always normal profits should be calculated as a percentage of capital employed. In this problem, 14 lakhs into 15%, it is coming to 2,10,000. Then future maintainable profits, that is adjusted profits, we have calculated 2,58,000. The super profit is the difference between adjusted future maintainable profits minus normal profit. So 2,58,000 minus 2,10,000, 48,000. This is super profit. So goodwill is 3 years purchase of super profits. So super profit is 48,000 into 3, which is 1,44,000. So this is a simple calculation of goodwill under super profit method. Super profit method so far we have calculated is considered as one of the prominent methods. It is very easy to calculate and easy to understand also. The third one is capitalization method. Here capitalization means already whatever the profits which we earn, we are just adding back to the capital, that is called capitalization. So here under capitalization method we can approach two methods, capitalization of average profits and capitalization of super profits. So we have to calculate the average profit, then all the average profits are to be capitalized under average profits method. Then capitalized value of average profit, the formula is average profit into 100 divided by normal rate of return. Then capital employed already seen, total assets minus external liabilities. Goodwill based on average profit, here we are calculating capitalized value of average profits minus capital employed. So here we are calculating the goodwill on the basis of capitalization method. So capitalized value of average profit is to be taken minus capital employed. Then second important issue is capitalization of super profits. Under this method, first of all we calculate the super profits and then calculate the capital needed for earning such super profits on the basis of normal rate of return. This capital is the value of our goodwill. So under super profits capitalization method, goodwill is calculated based on this formula, super profits by normal rate of return into 100. So we will see one example. So under capital, generally most of the cases under capitalization method only super profit method is taken, unless and otherwise it is given, only average profits may be considered. But whereas in most of the cases capitalization of super profits only may be calculated. It is depending upon the element that is given in the problem. Now we will see the illustration. If a firm earns rupees 75,000 as its profit and the normal rate of return expected by the firm is 10%, the assets of the firm are 7,20,000, liabilities are 2,40,000, value of the goodwill under capitalization method we have to calculate. So capitalization of future maintainable profits we have to calculate. First step, capitalized value of the business is equal to future maintainable profits, FMP nothing but future maintainable profits divided by normal rate of return. So future maintainable profits already given, it is 75,000, normal rate of return is given as 10%, FMP by NNR is equal to 7 into 100, 7,50,000. So that is capitalized value of the business. So capital employed is equal to total assets minus total external liabilities already given in the problem. 7,20,000 minus 2,40,000 is coming to 4,80,000. Now goodwill on the basis of capitalization of average profits method is equal to total capitalized value of business minus capital employed. Total capitalized value of the business now we have calculated, it is coming to 7,50,000 minus capital employed already calculated, it is 4,80,000. The resulting figure is 2,70,000. So this is the capitalization of average profits method. Then next method is the same problem, we can also calculate goodwill under super profits method. Normal profits is equal to capital employed into normal rate of return. Always normal profits under any circumstances should be calculated only capital employed, because the amount of profits, absolute amount of profits is not important in any case. The relative profits are most important. Relative profits means always how much amount we have invested and how much returns we are getting. So in order to calculate the relative profits, we need to calculate normal rate of return on capital employed itself. So capital employed that is given is 4,80,000, normal rate of return is 10%, which is coming to 48,000 normal profits. So super profits already we have seen the formula, future maintainable profits minus normal profits. So future maintainable profits 75,000 minus 48,000 is normal profit, which is equivalent to 27,000. This 27,000 is super profits. So goodwill calculation on the basis of capitalization of super profits, the formula is super profits by normal rate of return into 100. So super profits 27,000 divided by normal rate of return 10% into 100, which is equivalent to 2,70,000. So here once we recapitalize the things whatever we have seen so far, the goodwill is an intangible and fictitious assets. Goodwill varies from firm to firm as well as from business to business. Organizations which enjoys highest reputation, organizations which enjoys highest profits will enjoy highest goodwill. That is why so far in this chapter we have discussed the importance of calculation of goodwill or need for valuation of goodwill, important characteristics or features of goodwill, then various methods of calculation of goodwill also we have seen. Now it is the time to see various questions from the students' point of view that they have to focus in the examinations. Number one is define goodwill, state its features. So we have to write all the characteristics or features of the goodwill by making one or two list of definitions. Second question is explain the need and importance of goodwill and valuation of goodwill. What are the need and necessity for valuation of goodwill also? Under sole proprietorship, why goodwill is to be calculated? Under partnership firms, why goodwill is to be calculated? In the case of joint stock company, why goodwill is to be calculated? Under what circumstances goodwill is to be calculated? We have to discuss in detail. The third important question, either you can face either in the form of theory or problem, is methods of valuation of goodwill. We need to describe various methods of valuation of goodwill. Already we have seen that there are three most important methods. One is average profits method, second one is super profits method, then one is capitalization method. Again in capitalization method, capitalization of profits based on average profits, capitalization of super profits method also we have to discuss. So each and every method also to be discussed with respect to pros and cons, advantages and limitations. So a student can expect these type of questions in an examination. Finally, we have to see the various list of books or suggested readings that can come across by the student. Once the student can follow, apart from their regular textbooks, they can refer these books. Number one is Advanced Accounting by Jain and Naren, Kalyani Publications. Next, Advanced Accounting, Shukla and Grewal, Chand Publications. Advanced Accounting, Telugu Academy Publications. Nowadays, Telugu Academy publishing a good number of books. So, for the student of rural background and Telugu medium students, it's very easy to understand these Telugu Academy textbooks. Then, Financial Accounting by Narayan Swamy, Pearson Publication. This is an excellent book. A student can refer this book for advanced learning concept, for application of various accounting concepts for business decision making, application of accounting tools for various management decisions. This Narayan Swamy book is quite useful. Finally, Financial Accounting by S.N. Maheshwari, Himalaya Publications, also quite useful and most interesting textbook. Thank you, one and all.